After reaching all-time highs above $124,000 in October 2025, Bitcoin entered a sharp correction, plunging into the $80,000 range, its lowest level since April, and sparking intense speculation about the potential onset of a new bear market cycle. Currently trading at $86,274, the asset has posted a decline of over 22% in the past 30 days, breaking both technical and psychological support levels that had underpinned the bullish narrative. This abrupt move has not only shaken retail investor confidence, but also raised questions among institutional analysts about the sustainability of the current price regime amid growing volatility and negative ETF flows. Despite the steep sell-off, there are signs that the worst may be over at least in the short term. According to Ana de Matos, technical analyst and trading partner at Ripio, the bottom of this move was reached on November 21st, when BTC touched $80,600, its lowest point of the year so far. Since then, the asset has launched a relief rally, climbing back to $88,127 in recent sessions. However, the macroeconomic backdrop offers a moderately optimistic counterbalance. Andre Franco, CEO of Boost Research, observes that global markets are being buoyed by expectations of another Federal Reserve rate cut in December 2025. Data from the CME FedWatch tool indicates a 57% probability of a 25 basis point reduction, signaling that the tightening cycle may be nearing its end. This scenario favors risk assets, as lower interest rates tend to reduce the cost of capital and boost global liquidity factors historically positive for Bitcoin. Moreover, the US dollar has remained stable. Without strong upward moves that could further pressure foreign-denominated assets, oil prices have declined slightly, reflecting caution in the commodity sector, while the Japanese yen remains under continued pressure, highlighting the challenges facing developed economies amid US monetary policy. In this environment, Franco projects a moderately positive short-term outlook for Bitcoin, supported by the potential for additional Fed stimulus and increased global liquidity. However, he cautions that this impact will be limited. Unlike previous cycles, such as 2020 to 2021, marked by trillions in fiscal and monetary stimulus, today's rate cuts are modest and reactive, not expansionary. Therefore, Bitcoin is more likely to enter a phase of sideways consolidation or experience a modest corrective bounce, rather than an aggressive breakout to new highs. For Franco, the market needs more than expectations. It needs real institutional capital flows, which for now remains subdued amid uncertainty over inflation and the pace of economic slowdown. In summary, Bitcoin stands at a technical and psychological inflection point. The over 22% correction has deflated autumn's euphoria, but has not destroyed its long-term fundamentals, such as post-halving scarcity, institutional adoption via ETFs, and growing integration with global financial infrastructure. Yet elevated volatility and recent negative ETF flows indicate that market sentiment has shifted from buy every dip to wait for bottom confirmation. In the coming days, attention will focus on three decisive factors: the Fed's December decision and the tone of its statement, the behavior of net flows in ETFs, particularly BlackRock's EBIT, the price's ability to hold the $82,500, $8,800 range. In the meantime, prudent investors should avoid emotional reactions. As history consistently shows, deep corrections are an intrinsic part of Bitcoin's adoption cycles and often represent strategic opportunities for long-term positioning, provided they are executed with discipline, risk management, and clarity about investment horizons. After all, the market isn't questioning whether Bitcoin will survive, simply testing who has the conviction to stay.